Shout out to Snowball, our incredible new sponsor, a private community where top entrepreneur investors share private deal flow, wins, tough lessons, strategies, get advice, and so much more. Check out www.snowballclub.com. Let's grow together with Snowball. Hello, and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Ignacio, and I just forgot how you. Why don't you pronounce your last name for me? Because I know I'm going to butcher it. I just forgot how you said it. So say your name for me.
Villanueva.
Okay, cool. I didn't want to do it after we talked for 2 or 3 minutes after I told you to pronounce your last name, and I thought, man, I'm going to get it wrong because I forgot how he said it was. But I love unique names. Sorry for that, and we'll just keep moving here. I'm looking forward to this conversation today. I know that you're part of Boopos. You guys finance online businesses and stuff. Why don't we start off with the same place we start with everybody? What's your origin story? Kind of how did you start? And then we'll talk about Boopos and what the origin story of Boopos is too.
Yeah, so definitely. So I'm originally from Spain. I was born and raised in Spain. My dad was in the Spanish military, so I always lived. There's a military base, there's a joint military base between the U.S. and Spanish Navy in Rota, south of Spain. It's a beautiful place next to the beach. So I was raised there. I went to the American school and everything. Then when I went to high school, I was always a fan of rugby. I played rugby for more than 11 years. I went to the national team, national rugby team. So I played professionally for 11 years. In 2016, I went to Olympics. So I was an Olympian rugby player for the Spanish national team, 2016, Rio de Janeiro. It was an amazing time. Unfortunately, in Spain, it's a small sport. Spanish people only like soccer, Real Madrid, Barcelona, perhaps a little bit of tennis. But apart from that, you cannot make a living from any other sport. So funny enough, I tried 2 NFL teams. So I had 2 different tryouts, one with the Steelers, another one with the Tampa Bay Buccaneers right before they won the Super Bowl. Unfortunately, I didn't get drafted. Obviously, I didn't have that much of experience. But yeah, so I got out of the rugby while I was playing for the national team. I studied 2 joint degrees, business and law. So I always knew that at some point of my life, I had to stop playing rugby professionally. So after a while, realizing that I couldn't live out of sports, I basically started a fintech company. And then I met someone who built the first unicorn in Spain. That's Juan Ignacio Garcia. He's the CEO and founder of Boopos. So he kind of took me in, one of the first one on the team, and we built this amazing platform, which I think it provides a very good feedback, capital, and many good aspects of the SMB acquisition space. So I've been in the M&A space for quite a long now. I would have been a sports guy if it was up to me, but it didn't work out. But now I'm happy. I think M&A has played out very, very well for me.
Interesting. I've only played rugby twice in my life. In the Air Force, we had soccer teams and other stuff, and there was a group of people trying to get a rugby team together, and they would go out and practice. And I did practice for them a little bit, and then we played a little game where it was kind of like a scrimmage where we're playing against other people that are trying to create a team, and it kicked my butt. It's a totally different sport. So a lot of respect to you there. Interesting. So that's a really interesting background. Now tell me about Boopos. I love the name. There's actually a Italian restaurant here. It's not any. I don't think it's good anymore, but it used to be really good. When it's just before they franchised, it was just one. It was in San Francisco. It's called Buca de Beppo. So when I hear Boopos, I think about that. But Buca de Beppo is basically you went in there, you'd order food, and you didn't order your own because whatever they brought you was enough to feed your entire family. So you order spaghetti, they'd bring you like 3 pounds of spaghetti, right?
Yeah, so that's a funny story. Everybody we talk to, they always ask the same question: where does Boopos come from? We don't have a meaning to it. It's just the CEO decided to put that name. And just what we do, we've been in the market for a while. We initially wanted to buy businesses ourselves. Kind of that was in the Thrasio bust and Elevated Brands and all of those. So we started looking into building a roll up strategy. We quickly realized that hey, we actually don't have any experience operating these brands, but we had experience in the banking industry, right? So we decided to just focus on allowing people that actually know how to operate the brands and facilitating the acquisition through financing capital, non-dilutive. So we saw the space, we saw that the only options remaining were kind of SBA loans, which required a personal guarantee. It takes at least 90 days. And the worst thing is it takes personal guarantees on the house, right? So people are not willing to do that, especially if you're trying to buy a really good business and you have to wait 90 days. Sellers usually like to go with an upfront buyer. So we were taking the place with SBA. We don't ask for any personal guarantees. Our process is much more quicker. So we started like that, financing all sorts of online businesses. We started e-commerce, content site, marketing agencies, SaaS. We kind of shifted in the last few months, which we can talk about. But essentially, what we do is financing acquisition for subscription businesses.
So any type of subscription business, so that's SaaS software, paid newsletters maybe? And what else would be are brick and mortar subscription businesses like maybe a gym where they have subscriptions? Is that in that realm or is it still
Yeah, so
online?
right now, what we've done so far is we need the ability to track the monthly recurring revenues from the clients and the payment processor. Because we connect, let's say you're using Stripe, we connect to your Stripe account, and we're going to have the ability to track the monthly revenues and make sure that the business stays in shape or stays in the projected revenues that they had on their P&L, right? The problem with brick and mortar is that they use a lot of cash, so you never know how much revenue the business are really making. But if at some point we find a business, a vertical that we're able to connect to their payment processor and we could see their monthly revenues and how they trend, we wouldn't have a problem financing for those businesses.
Yeah, we interviewed somebody like we were talking beforehand. It's been a long time. One of your guys is from early on, maybe a year and a half, 2 years ago, early on. And it seemed like you still did the same thing. You got into Stripe or you looked at the payment processing and that's how you verified the recurring or the monthly income. It seems to me I remembered that's also how you kinda structured what the payment would look like is based off of that revenue,
Yeah,
right? Do you guys
exactly.
still
So,
do that? Yeah.
yeah, good memory. So we started off as revenue based lending, which meant essentially we connected to the revenues on a monthly basis, and then we'll determine what percentage of those revenues had to be paid back. So it will change. The good thing with e-commerce, as there's very seasonal, on the higher months, Christmas, you will pay a higher amount, but in the summer, where you're kind of not as high revenue company, your monthly payments will lower, right? Will be easier for you. However, we changed our model to a fixed term loan. At the end of the day, it was easier for our customers to kind of project the monthly payments. It was also easier for our investors to understand our business model and our projections, and especially for the financing team to get paid on a monthly basis. It's just hard to calculate every month for every single client how much they have to pay, right? So we decided to shift everything to a fixed term loan, and now is a more traditional term loan where amortization starts after a period and then interest on the remaining balance.
Yeah, I remember having that conversation and thinking how complex it would be that you almost have software that would have to do it and have auto pay or something because it would just be so complex that if it was 100% revenue based and it was based off of, it was seasonal, I could see where the complexity would really be a, you know a barrier to really wanting to do anything manually inside of that realm. Talk about the type of companies. What's your ideal customer? If somebody came to you right now and they're thinking about buying companies, what is it you're looking for them to present to you, and what
Yes,
type of companies?
I will take the question. I will adapt to it. I'll change it if you allow me to. So there's three
Absolutely.
yeah, there's three types of buyers that we've identified in the market, right? First of all, you have roll-up strategy. They're usually private equity. They have a lot of experience in the financing space. They know how to structure deals. They understand the power of leverage. So they're always looking to put as little capital as possible, and they usually are composed of a team of someone that has really experience in economics, P&L, financing, etc. They have a really good operator, and then they have somebody that knows how to talk to investors, knows how to raise capital, right? So what these people do, they'll raise capital. Let's say they raise between 1 and 3 million to start off with, and they'll start buying brands, right? So we're essentially what Boopos does is we take the LBO strategy that private equity firms have been doing for so many years, and we're serving them kind of as a first vehicle to get traction, right? If you think about it, if you're able to raise capital, let's say you raise 1 million, you have two options. You can buy one company worth 1 million, or you can leverage, partner with Boopos, and acquire three companies worth 1 million, well, 1 million each, where you're doing a structure where you're putting 300,000 down, will finance, let's say, 300,000, and then you do seller financing on the remaining amount, right? So do you do one third, one third, one third? So these roll-up strategies, they partner up with us. They'll acquire around five, six, seven brands. They'll show traction. They'll show that their model works. And then at some point, they have two options. Either they raise equity again and they do the same thing over again, where they acquire five, three, four, whatever amount of number of deals they set up in their investment thesis, or they could raise institutional debt at that point and use the capital to repay us off, which we don't have any issue. So essentially, it's just a 2 to 3 year plan where the idea is I'm going to buy the most companies I can get my hands on. I want to make sure that I have a good investment thesis strategy in place, that I know how to operate these brands, but then I'm going to scale my process and refinance these guys, right? So that's one type. Roll up strategies, a lot of experience. They understand leverage, they understand our terms and why our cost of capital might be a little bit higher than SBA. Then we have sophisticated buyers. It's just people that know how to operate brands. They love buying and selling in general. So they've managed to operate a business, they've grown the business, now they want to sell it because they're not really, they're good to taking the business from 1 to 3, but then from 3 to 4, they just either don't enjoy it or they're not very good at it. So we work with a number of those where they might buy a company 1 month, maybe buy another one in 4 or 5 months, sell one company within a year. And they're always back and forth between buying and selling. They're very sophisticated entrepreneurs. They're usually by themselves. Maybe they have a partner or two at tops, but they do understand a little bit of leverage. They understand that the less capital they put into these acquisitions, the more acquisitions they can do, and the bigger return of investment, right? And then on the third category of buyers, we have first time buyers, individual buyers who they might have a little bit of experience operating brands, but they've always done it under the umbrella of someone else. And now they want to take the risk of being their own bosses, kind of pursuing this economic independence that everybody is talking about now. And they just want to engage. They know that they cannot go to SBA because they might not have a house to put as personal guarantees. So they partner with us for their first acquisition. So those kind of the three types of buyers: roll up strategy, more experienced entrepreneurs or operators, and then the first time buyers.
Are all three of them kind of the one third, one third, one third model where I bring a third of the cash, you guys invest a third of the cash, and the seller finances the other third? Or is it changed based off of risk and the user?
Yeah, I guess it changes also based on experience and your ability to structure a deal, right? And at the end of the day, if you're a seller or if you're some sort of a savvy seller, you want to make sure who you set up a seller note with because we've done over 150 transactions. We've deployed over 70 million by now. So we've seen all sorts of transactions with all sorts of sellers and buyers, right? And something that we've realized, unfortunately, with individual buyers, they're not very good at making the simple math, right? In terms of how much debt you want to acquire for this acquisition and how you're going to structure the seller note. And the most important question is, how are you planning on financing the seller note? Because on paper, the numbers have to make sure on they have to make sense on paper, and you have to underestimate your ability to grow the business. 'Cause everybody thinks they're going to grow the business 20% year over year every consecutive month, where it's actually very hard to scale a business, especially if you've never done it.
Only yeah, even the PE firms that buy companies through acquisition average, I think it's like 25 to 30% growth year over year, and they're doing acquisitions to grow, right? So I hear buyers all the time. Yeah, I'm gonna buy the company and grow at 40% year over year. It's like, yeah, no, you're not. You think you are, you might, but I would lay odds that you wouldn't. I'm a betting man, so I would bet against you on that.
Yeah. Definitely. So you have to be careful. So I would say, yeah, when it's a roll up buyer, we feel more comfortable with a one third, one third, one third structure. But when it's a first time buyer, we really want to advise the guy, hey, I mean, we want to do it. We can do it. And we've done it in the past. But if I want to be your advisor, your financing advisor, and I want to tell you what I think you should really do. I don't think a one third, one third, one third strategy it's going to work in your favor because in the end of year two, you're not going to have cash to pay both, to service the debt and pay off the seller note. So we kind of suggest a more even 50-50 approach or 40-40-20, something like that. More
Yeah.
realistic.
Now I come from a real estate world and a world where, and the stuff I'm looking for, other than things we buy cash for, smaller size deals, where there's usually assets that are leverageable as collateral. So, for instance, the real estate world, if I don't pay the mortgage, they get the house. And then in a lot of the business transactions, if I don't pay my debt, they get my equipment, and maybe I own the real estate, and they get the real estate out of underneath it. How do you guys how does Boopos secure their notes?
Right. And for what you say, I mean, at the end of the day, you don't have to manage house or real estate. You could always sell it. It's always going to keep the price and their value, right? So yeah, that's one of the things that people have to understand about Bupos is that we don't require personal guarantees. So, but we do take collateral of the assets. Now that might seem scary, but let's say you buy a SaaS, revenues decrease 20% year over year over 5, 6, 7 consecutive months, and you cannot make the payments. Yeah, we might take over the SaaS, but what are we going to do with that SaaS, right? It's already far enough down the drain that there's potentially nothing to do about it. So it's a very high risk for us to finance these opportunities. So that's why in the cost of our capital is a little bit more expensive than the SBA because SBA at the end of the day they can go to your bank and say, hey, I'm going to take whatever you guaranteed of these assets.
Do you have a turnaround team? Like, what do you do with those assets? I mean, as an acquisition guy, like you said, you got over 150 deals done or something like that. And you had $70 million deployed over the term of Bupos's lifespan. What happens when something comes back? Do you guys end up dissolving them, or do you put it to a team to turn it around, or do you sell
Yeah,
it to one of
so
your other buyers?
the later is what we aim to do. So initially, if we've had a relationship with the seller throughout the process, because sometimes we have to talk to the seller to get some information, connect some accounts during the process, and we always reach out to them, say, hey, we have this situation. Do you want to take over the business? Obviously, they've already get the capital from the closing stage, and now they get a free asset that they know inside out. There's always a win-win situation for them. So I would say going to the seller would be our first option, and the second option is we do have a group of buyers that we've worked in the past with. They know they're good, very good operators, so they're really interested on taking some of these opportunities. But I will take the opportunity to do a shout out. If somebody wants to take over these stressed assets, they can shoot me an email. I'll be happy to put them in contact with the right person.
Yeah, it might be something where, like, look, I've already got, somebody might need to submit a portfolio where it's like, hey, here's the three SaaS companies I own. If you've got anything that's distressed that has customers in these three realms, we'd love to talk to you, right? Because a lot of times these SaaSes, Like, here's a good example. There's a lot of SaaS companies or membership companies that are CRMs for marketing agencies. They're a general software tool. They're a CRM, but they've honed in and created something special for a niche to where if I own a CRM software as a service company for marketing agencies and I'm thinking about getting into, I don't know, link building or SEO, and you reach out and go, "Hey, I've got a depreciating asset here. I've got something that we're gonna have to take ownership of that's a software as a service for an SEO company." They're still making money, but they need somebody to take the helm and treat them right. I'd rather start from that than actually start from, "Okay, I'm gonna go hire 5 guys and create an SEO arm of my company," or I'm gonna go buy, or even better, I just bought an SEO company that does SEO, and you've got something that's in that realm, and I don't have a SaaS side of my thing, right? That's who I'd wanna find as my buyer is like, I'm already up and running in SEO, we do everything manually, you have a SaaS company that services that industry, you
I mean,
know?
absolutely. Growth by acquisition is our number one sport, right? We
Yeah.
always love that and we always encourage that. But going back to the first question, you have to understand from the three types of buyers that I was mentioning, what happens is first time buyers, sometimes they don't know how to manage these brands, right? So someone that actually knows how to operate SaaS, operate subscription business, even if they do the minimal work, which they know how to do, they'll bring the revenues back up, right? So they'll know how to operate those assets fairly
Mhm.
quick. So it's a good opportunity for people that actually know how to operate to reach out to us and say, "Hey, I'm willing to take on those opportunities." Now, the sophisticated buyers, I think it's a little bit more complicated. If a sophisticated buyer has decreased revenues, there's not a lot of people. Maybe there is the right person to do so, but chances are going to be smaller. And then with the aggregators, what happens is they usually start buying brands, and sometimes they have too much overhead cost. So they overhire people. And what happens is at P&L level, at LLC level, they're profitable and their business are going absolutely great. But they overspend and they overhire. So the overhead expenses are just too high. So there comes to a point where they're trying to raise their next round of equity and their VCs look at their Hoco P&L in their balance sheet and they say, no way. So at that point, they just dilute themselves and they have to get rid of some of their best performing assets so they can re-engage with the acquisition space. So those are also great opportunities that business wise they're performing very very well. They're great opportunities, but it's just for some reason the operators didn't perform well in terms of setting up the whole costs.
Yeah, divestitures happen a lot, right? Their company buys something that has 2 or 3 different avenues, and they focus on the one they wanted and let the other 2 just sit there and kinda idle, right?
Yeah.
And now they go raise another round, and the new investors look at it and go, "Why in the hell do you own this thing over here? It's totally off character with everything else you have." And, a lot of times it's because, well, it came with, X, Y, and Z that we acquired.
And
The
also,
pro
debt, you have to be careful when you play around with debt, right? It's always
Mhm.
said debt can be very, very good and it can be dangerous as well, right? So if your revenues decrease just a little and you're too over leveraged, that could just, it just, they could kill the whole structure, right? So
Yeah.
these things also happen sometimes. It's like where you're too over leveraged, the minimal change on interest rates, if they raise or the revenues go down for whatever reason, then you're automatically under stress and you have to act quick on it, right? So that there also goes opportunities where just people are over leveraged. Doesn't mean that they're bad opportunities.
The other thing is almost all businesses, whether they want to believe it or not, are a little bit cyclical, meaning they have cycles of up and down throughout the year. And if you don't watch it and you plan for thinking everything's gonna, especially us optimists that come in and we're gonna grow everything 40% per year, you look at it and go, yeah, I can handle a $10,000 a month payment. Like, yeah, you can on your best months and on even on your good months. But if you look at your down cycle month, you're only 5% over that. So if you have a 10% market swing or you have something that happens or a glitch in software and you lose some customers, those 3 months that your down cycle for the year, you're gonna have to make sure you have cash reserves from previous months to cover those expenditures. And it happens in all business. A lot of people, we were on another show recording. We were talking about companies that do a lot of sales between Thanksgiving and Christmas, right? The e-commerce side of things. And what happens if you don't plan that out? The 4 or 5 months or 3 or 4 months leading up to Thanksgiving, you're buying inventory and building up and getting ready. So you got a lot of expenditures. And then the funny thing is those guys, the guys that own those always want to sell them in January or February. They've already cashed their big cash check for the year, right? And they want to pull the cashes out of the company. And they don't, if you look at this, you look at the EBITDA and all the high level numbers, they look great. When you look at the month to month cash flows and go, wait a second, you got 4 months out of the year where you're barely getting by. That debt structure is important to match against any debt you take on carefully to match up against, not just like, is the EBITDA going to cover it, or is it profitable enough to cover it? But look at it per month per month. Or do you have bad months where most of our money's made in these 3 months or whatever? It's a little bit different subscription businesses because usually they're steady, but not all. Not all, but even subscription businesses are steady. Look at gyms, right? Gyms, the subscription of January, February, and March is up by June, July, and August. They're having to try to go into collection for some of those,
Yeah.
right? Hey there, Hot Exit family. Today I'm thrilled to talk about Snowball, our incredible new sponsor. This community is more than just an investment hub. It's a place where growth is holistic. A private community where top entrepreneur investors share private deal flow, wins, tough lessons, strategies, get advice, and so much more. Snowball is a network rich with like minded, experienced entrepreneurial minds, including investors, founders, CEOs, and doers, all dedicated to meaningful growth. Snowball threads are like a daily masterclass. This isn't just about financial success, it's about enriching your entire life. If you're looking for a community that supports your entire entrepreneurial journey with shared wisdom and collective support, check out www.snowballclub.com. I believe their approach to compounded growth in wealth, health, network, and relationships could be the game changer you've been seeking. Let's grow together with Snowball.
Yeah. So one thing you mentioned was the cycles, right? And I just finished reading the book, the Ray Dalio, The New World Order, and he talks about this in this book, and it makes sense. Everything is a cycle, right? Even when you study the numbers on August, right? Everything, the global warming, isn't just a cycle. The economy, the debt, the long term debt versus the short term debt is all very cyclical, right? So with the SaaS businesses, e-commerce, it's all the same. So you have to be careful. One of the advantages that I would say working with a financial institution. Now it doesn't have to be Boopos. I'm not trying to provoke people to work with us, but we do run the analysis on each of the brands, and we'll look at things like seasonality, trends. That we'll look at the monthly payments and everything, the revenue. So we set your foot to the ground, right? And unfortunately, people always think they're going to grow the business. They're going to have enough cash flow to pay the debt, and they're going to be able to service debt without any issues, and the business is going to keep on trending up. But one of the things is we look at the cash flow right now. What's the business looking like right now? And that's how the business is going to look like in 12 months. Now you could grow it, but let's just take the worst case scenario where the business stays the same, or even if the business is downtrending a little, you can project a little bit of that downtrend as well to be sure that you'll have the ability to pay the seller notes and that you can have a good deal structure. Something that we've noticed is that businesses that are trending down have a very high chance of keeping down or keep the revenues decreasing post acquisition, right? So that's something that you want to take into consideration for both setting up the purchase price, asking for debt, because you can go to SBA, get a 90% debt through 10 years. But if the revenues are going down, you want to take that into account, especially if you structure the deal with a seller note. So we're part in analysis, and we're the first people interested that you secure a good deal and that you have enough cash flow to both service the debt, but also pay the seller note.
Interesting. So, what would somebody bring to you? What would be, I mean, I guess you get to log into their Stripe account and stuff, but if somebody's structuring a deal, is there anything unique about putting together hey, we want you to help us fund this, like a package, or or submit? I'm sure you have online forms and stuff people submit. Is there anything unique they need to look for inside of these companies to know it's a good deal for you?
So yeah, I would say that there's cash flow positive because we're a cash flow
Mhm.
lender. It has to have at least 18 months. So those 12-month companies, I mean, there's not enough history to kind of bet anything on it, right? And then it has to
Yeah.
have stickiness. So we have to be able to look at the customer retention rate and see that customers are actually staying on the business and not churning away. So usually the process with working with Boopos is you'll onboard to our platform, and we have partnerships with all the brokers, most of the brokers in the space, right? So Acquire, Empire Flippers, Quite FE International. You can either go to their site and look for a SaaS that you want to buy, or you can come to our marketplace where we have all those opportunities already pre-approved on our marketplace, right? So let's say you're going on Acquire, you see a SaaS that it's quite interesting. You request the information, and then you go to our platform. You upload the information, very streamlined process, and then we'll analyze the deal. We have a committee every Tuesday, Wednesday, so every other day we're basically analyzing businesses. So within 2 to 3 business days, we'll analyze the business. We'll send you a term sheet, and then we'll structure how the monthly payments will be done, right? At that moment you can go back to the P&L, put some numbers in, see how that will affect your P&L, and then we basically have a personal advisor for every buyer that we work with to make sure that we run over different scenarios in terms of deal structure. So we subject different deal structures for the buyers. They say, okay, I'd recommend you putting 30% down for this business, or 40% down, or I recommend you doing 50-50. So we individually work with each of the buyers to make sure that they get the best out of the deals.
That's interesting. Interesting. Now, is there any industries or anything you guys just don't touch?
Yeah, so unfortunately, e-commerce being one of them. So here's the thing. We started off financing e-commerce. We had a great partnership with Empire Flippers. I think we did like 10, 15 deals every month. But unfortunately, the performance on e-commerce was not as good as we expected. And the reason for that is that the life of well, the time it takes for an e-commerce to do horribly wrong is unfortunately very, very quick. It can turn upside down from one week to the other.
And a lot of it has to do with there's a lot of me too's out there, I guess we would call it. You start it's a very competitive space. You get something that's really kicking it on like Amazon or Shopify, your competitors will see it, and the next thing you know, they're going to have a similar product line right up beside you in the same application, the same platform that Amazon have put right beside yours, right? I know people, it's been a few years now, but I know people that were they would that's how they made their business. They made their money. They go on to Amazon, they look for the best sellers, then they would go and read the 2 and 3 star reviews and see what's wrong with the product. They'd fix those items, introduce a new product side by side, and within a month or two, they're getting 5 star reviews and 4.5 and 5 star reviews because they fixed what was wrong and they bust that bestseller out of the space, right? And it was simple things like phone charger cables and just random stuff, but they were killing it. One of the guys is doing 2.5 $3 million a year, and all he does is he hunts down really good selling products, reviews the 2 and 3 star reviews, figures out what's wrong with the product. Maybe it's service or shipping, or maybe there's a flaw in the cable. He'll contact the same manufacturer. He figures out who's making it and go, hey, I'd like to order a shipping crate of this, but I want you to. He's an engineer by background. He goes, I want you to use this spring instead of that in the flashlight, and solder it with this spec of solder instead of that, and then I'll order a bunch. So he makes it sure it won't break like the other one did. And it doesn't take long for people to order his and realize it doesn't have the same problem.
I mean, I wish all our buyers knew. They were software engineers. They knew how to talk to everybody in the shipping, change the product around. Unfortunately, that's not what happens. And you have to
No.
think. Let's say you buy a business, you buy an e-commerce, and all of a sudden Amazon changes their monthly fees. You have to pay a little bit more, right? So what happens is you can now spend less in marketing. So when you spend less in marketing, you make less revenues, and everything is just on a downfall very drastically. So yeah, e-commerce is a great business to buy and
Mhm.
sell. Some people do it magnificent, but I would say if If this is your first acquisition, if you don't know the space absolutely well, you may want to think about getting into e-commerce just a little bit.
So, as you said, starting e-commerce and stuff. The other thing about the Amazon one is like for the same guy I was telling you was doing the phone products and stuff like that. He's lost entire product lines because Amazon decides that they're gonna do an Amazon-based product in that. At one point, I don't know if they still do this, but Amazon was brutal for a little while. Amazon reached out to him and said, "We'd like to buy your business, and we're creating an Amazon-based product. Here's our offer. You can either sell to us, or we're going to compete with you side by side." And there's nothing he can do because he knows once he puts the Amazon price, they're going to dominate him. It was a cell phone type of, it was still in that cell phone space, or maybe he did some stuff with rechargeable batteries for a long time too. It might have been something in that space, but there's now the Amazon brand was going side by side. Like, he got the good grace of God. They offered to buy him out at a low rate, but it was something. And he ended up just selling a six-figure piece of his business off because he was gonna have to compete with them head to head. So that's another one of those when you're on these big platforms in e-commerce space, you're at the whim of the big guys. That's one of the reasons I don't play in that realm is I try not to play in any realm where a single player can change your game overnight. Like, just they can change their rates or they can change an algorithm and just totally ruin your life. That's why I like to when I was telling you beforehand, you were talking about newsletters and things I like to acquire. It's because I own the email list, right? To where if I have a website, Google, I want websites where the majority of my readers, I have their email list and I have them, on my list, and I'm getting traffic from all kinds of links and stuff out there, not just Google. I'm getting link based traffic because Google changes their algorithm. I Googled it once. And I said, "How often does Google change their algorithm?" I think it was like 600 or 800 times a year. It's crazy. And they take major updates, but they're constantly changing that thing. And you're one change away from being from first page to 50th page.
Yeah,
Same thing happens in this e-commerce space.
yeah, content sites, you have to know the game. I would not recommend anybody to get attracted by the high returns that the content sites have because you might go into a marketplace say, oh, 90% SDE, I want to get one of these. It must be easy to run it, right? But then, as you mentioned, Google updates, it will just destroy you, right? It's you have to know this stuff. Regarding e-commerce, what we've seen though is back in the day it was fairly easy to compete on Amazon, and the main reason there was two main reasons. First of all, there wasn't as much competition, right? So if you wanted to sell whatever phone cases, right, there weren't as many sellers selling phone cases, and their marketing on Amazon was not as high. Now, as Amazon has raised not only their fees but also how much you have to spend on marketing, marketing just really became the real estate for online businesses, right? So you're spending at least what 20 to 30% on marketing on Amazon, right? So if you were to sell on Amazon or if you were to get on e-commerce, what I would recommend is look for something that has brand equity. Now, brand equity means people recognize your name. It has a brand to it. You can sell it in Shopify, WooCommerce. You can take it to Walmart in the future if you want to, but you want to create an audience that resonates with the brand, right? And selling these non-brand products on Amazon, I just don't think it's working the way it used to anymore.
Yeah. You want somebody to actually Google your brand name as opposed to go to Amazon and look for your product,
That
right?
exactly, yeah.
It's fine if you send them to Amazon to buy it, I guess, or whatever, but, you want them to go look for Nike shoes instead of going to the Amazon and say, "I need shoes," right? Nike's a hell of a brand, so that's probably something you won't achieve or buy, but bad example, but, it gets the point across. If
And then
you're
you have to understand Amazon landscape as well. 50% of products that are sold on Amazon are through Amazon products only, right? Now, 30 to 40% are big corporation Nike, Adidas, iPhone, whatever.
mm,
And then just the remaining amount were individual sellers who, again, there's tons of people making a lot of money selling on Amazon. I don't discourage that. I'm just saying if you want to get into the space now, I think you're a little bit too late to get onto Amazon unless you want to build a brand equity brand to yourself, right?
yeah, I get that. What about, like, Do you mess with anything in the TikTok shop now that TikTok shop has a shop open? I heard their fees are really high. Do you guys finance anybody that's got those type of stores, or I guess
No,
that's not a subscription base?
yeah, it's not a subscription. Now, actually, we haven't seen any of those. Now, we're always in the lookout for new verticals. We study a little bit YouTube channels. I know some people are buying YouTube channels now, but I guess it depends a lot of on the operator. So it's kind of hard to change hands there. We're always looking for again new verticals, something that we can get our hands on, where we could understand how revenues work. They work in a subscription model, and that we can connect to the payment processor. So, I mean, open to suggestions for anybody listening to this.
How do you deal with so inside of newsletters and YouTube channels and stuff like that, there's a little bit of, I wanna call it social cloud or something. Like, I know I have paid subscribers on my newsletter that pay for subscription because they love getting my podcast. They know I do a lot of this stuff for free, and they reached out and go, "How can I support you?" And I just kinda jokingly said, "Well, subscribe to the newsletter." I've got one that's like $10 a month, 9.95 a month. It's just a cheap one, and they do. And I was thinking, do they even open it and read it? Like, I actually I look through there because sometimes I can see my active users. I can see inside of the statistics who opens every single one of them, and not all my paid subscribers. And some of those guys who, they give me $10 a month. I know it's not much on that. They rarely open the damn thing, right? And it's because it's kind of like what's that, Paleon or some of those other where they're just putting money into something because they listen to the show and they want to contribute.
Yep.
The problem with those type of businesses are, and it's insignificant in mind, but if you look at some of these other newsletters and some of their stuff, that social cloud is big, right? They've got such a following. They're such a social influencer that when that changes hands, a percentage of that company could go away because they're going to follow whatever that guy's doing next.
Yeah, I guess at that level, though, you have at that point, you have a few writers that are working for you that are creating most of the content. You're just
Yeah.
basically giving them guides on what to write. And then if you work with the seller for at least what 6 months of transition, and he kind of lures you into what his mindset is, I think there could be a chance where it's a smooth transaction or transition from
Yeah.
one owner to the other. And but yeah, we could potentially look at those. I mean, if we could see when the client start paying for the subscription and when they churn in terms of date, we can create a cohort analysis and then we could deploy capital on it.
I would buy new I would buy YouTube channels too, but mostly like the faceless ones where where they're doing like they're covering an industry or whatever, and I don't know if I would buy something with a figurehead on it, right? It's like same way it'd be hard to buy a podcast. There was a podcast recently for sale. They didn't say what it was, but it was a fairly top business podcast. I didn't sign the NDA because it was like 13 mil. But when you read it, I could figure out who they were just by like they're a daily podcast. They've had these particular guests on. They listed the size, by the descriptions. Like there's only two podcasts it could be, and I know the one of the two guys I've met him. He's not going to sell, so I know it's the other guy. But that said, how do you replace that? Right, that most of the people going to his show, he has a co-host, the one I'm thinking of, but unless he's sticking around,
Yeah,
people show up.
you
You know,
can't replace that. Um,
yeah.
I don't think
It's
so.
like this how to exit. I'm on every show. I've been doing a little thing where we do guests. We do occasionally we do one. I would like to do one a month where we have a guest host. Somebody else comes on and sits in this chair and interviews somebody they like to interview. We've done two so far. They went really well. So that was a pilot thing we're going to do. But in the long run, this isn't something I see that's going to be long term sellable unless I move myself out of it and have somebody else sitting in this chair on a regular basis. Not that I'm a super attractive person that people want to sit here and listen to, but people do come here because I'm asking questions. So that's the problem with the YouTube channels and even some of the newsletters out there. If it's written by the same person and it's not written by a team of writers,
It's
it's
impossible.
really hard to copy somebody's voice
Yeah.
and their the intellect, the way they think.
Well, there's two things I want to mention. First of all, is that perhaps you might want to look into it and create a bundle where you talk to different podcast hosts, get into a price, and then start selling a price to external buyers. Where hey, rather than paying 10 per podcast, you could pay 20 for podcasts, right? So that's a strategy that I've been learning about recently, and I'm very interested. Very interested in just how do you create bundles for people. And then the other one that I recently discovered, which I thought was interesting, is that the sunset strategy. So essentially, what you do is you buy a business, whatever business that's has high margins or high, even high cost, but it has a very low churn. You acquire that, you just let it out, let it die by itself. So by reducing all the cost that's on that business, say marketing, whatever people you have in the content, you don't pay for those at all, but just naturally the churn will start dying off itself. But the price of the acquisition is actually lower than what you make out of just letting the asset die, right? So I thought that was
Yeah.
a pretty interesting strategy with some of these subscription based YouTube channels or whatever. So you might, all right, how much is he spending on running the YouTube channel, right? And how many, so you just let it die by itself and you just recollect the payments naturally, and that might give you more capital than actually what you pay for initially.
It's interesting that you said that. I know one guy who's doing that. What he'll do is he takes the last because YouTube has a spike. Like when a show comes out, you got about a week or so where most of the 90% of the traffic for a show is within, especially like a subscription traffic, is within the first week to maybe sometimes depending on the show 2 weeks. Like I know I watched my first million or 1 million. Yeah, I think it's my first million or something like that. Anyway, I don't go back if I miss one, I don't go back and dig through and see if I missed any. I usually catch it within the first probably 7 to 10 days. So, I have a connection who he buys YouTube channels, and he just lops off the revenue from the spike revenue from the last 2, and he'll buy it based on, like, okay, I think he goes back 60 days. So, for 2 months, he looks at the revenue, he removes those videos. He's got an algorithm, a tool he puts it into, and it shows him what all the old videos are making, and he bases the acquisition based off of that because he knows if he stops it, like you said, he sunsets it, it's gonna trail off, and he's like, he says, "I look to make 3x what I put into it, and usually I make more because on some of them, he even tries to do something for them." So it's a brilliant idea. You're the second person I've ever heard even talk about that.
All
So,
right. I'm
I
glad I
like
brought
that you
it up.
brought that up.
It's just something similar to KDP businesses. I remember there was a time where everybody was just buying KDP businesses. But the real smart strategy on KDP business is just you have to find a book that's always going to stick around, right? So you want to buy the most boring book that you can see out there, like the Harvard Economics Volume One, right? Because you know that everybody always, no matter what, people are going to keep on buying that business, and with little
Mhm.
marketing, you're going to have people buying the business. With YouTube channels, I would go for a kind of similar strategy where I would see, okay, supply and demand unit economic one, right? And who's posting that video, and then reach out to him and see if you can buy it. Because you can, it's just very easy. How much are you making per month? What's the downtrend? You do the math, you buy at a lower multiple, and then just let it die itself. People are
Yeah.
always going to watch different YouTube videos, right? And some songs, like you could buy, okay, you buy what, not Bud Bunny, but if you can buy a local musician, you buy off his YouTube rights and then you just let it die out.
It's interesting. It's, evergreen products. So, what is somebody teaching on YouTube that it's not gonna change over time, right? The fundamentals of marketing, not online marketing just the fundamentals of marketing itself might be something, or the fundamentals of finance, right? Understanding balance sheets, those type of things, they don't change over time. A balance sheet, as far as I know, a balance sheet's been a balance sheet. I've been in business for 20 years. I don't remember them looking any different 20 years ago than they do now. They might there might be new stuff on there. There might be, when you're looking at the expense reports and stuff, different things are on the item, but an expense report's still an expense report.
Yeah.
So the fundamental businesses stuff, that would be that's interesting because that would be something that if you look at it and go, this isn't going to change much over time. And then you have the opportunity to revamp and remaster the videos, right? Because with AI and all this other stuff on out, you really don't have to put a face on it.
Not only that,
So,
but now you're starting to see, okay, what resonates with the audience. If it's a tutorial on Excel on how to do X, then you just keep on adding how do you do Y, right? And you keep on adding to that same kind of video and
mhm.
you work around it. But yeah, there's different strategies. And I guess so a few years ago it was Amazon and just sell whatever you can. Then it was a content sites. Now it seems like newsletter, YouTube channels, TikTok videos. I mean, we're gonna see all different types of fates. It's just about understanding. No, I would say know the basics because every time there's something new in the market, people seem to forget about the basics and just make sure that the basic maths add up. Right? Don't try to win the system. Don't try two plus two is five. Just as long as the basic maths makes sense, then go for it. Because there's always going to be this new thing that might get you money. But just make sure that you're not making dumb mistakes in terms of how do you position, acquire, set up deal structures, etc.
Yeah, there's a lot of PE firms that are hurting right now because 3, 4 years ago, SaaS was really hot, and they were buying these things at high multiples, like insane multiples, right? And now they're still better multiples for SaaS than a lot of other industries, but they're more down to earth, right? I haven't looked in the last 6 or 8 months. I don't know what the current multiple is to pay for a SaaS company, but it's nowhere near what it was 3 or 4 years ago.
No, not near. Right now, it's around, depending on the size, I would say between 3.5 and 5 times if the deal is below a million TTM revenues or enterprise value, either way. And it could go higher than that, above 1 million, I would say 6 times, 7 times. Oh, we still sometimes see even 8 times SDE. Sorry, I think I mentioned revenue. Usually is based out of SDE, seller discretionary
Right.
revenue. So it's around 2.5 to 4 times. And then if it's above a million, I would say you could see as high as 6, 7. And if it has a really good value proposition and very low churn, you could see as high as 8%, as 8 times.
When I looked at a few when we first got into this in the marketing realm, but marketing SaaS type of companies, and they were wanting, I don't know if they ever got it, but they were saying, yeah, the PE firms pay us 18, 20, 25, and this is 3 years ago, and I'm thinking, yeah, you can keep that. Like, what they don't get that is like, that's telling an investor that you have to wait 25 years to get your money back if you're not going to substantially grow it.
Right.
That's just not something I'm interested in as a buyer. So it discouraged me now. 3, that's almost 3.5, 4, that's normal, so I'd be back in the market for a SaaS. I haven't looked at it in a long time. Last time I looked at it was, like, 5 and 6. It was about probably 18 months ago.
So, yeah, so
Um,
I mean that has happened in 28 with households and how they value the price, right? And you over leverage, and then 4 months later, the house was more even worth even more. So you went to the bank and requested more loans, right? And that's where you over leverage. 3 4 years ago, also e-commerce, Thrasio was paying 10 times SDE at some point, and you have to like numbers they just don't add up. And also for startups, I mean VCs have basically put so much capital at such a high valuations that right now it's going to take companies many years, a few years, to get to the same valuation they raised 4 or 5 years ago, and investors are just not going to get the return of investment that they planned out.
you know Yeah, the venture capital world's always been a mystery to me. I played that realm a little bit where I had startups where I went and pitched to VCs, and I had some angel investors on 1 or 2 of them and stuff, and they were related. I don't wanna get too it was one of my biggest failures in my life. I won't get into it too much here, but I created an online dating service to keep people
Okay.
honest in their profiles and spent well into the 6 figures, almost 7 figures doing it. It had a couple angel investors, was in the realm of pitching VCs when we finally decided it just wasn't gonna work, and we shut her down. That world is intriguing because it's not logical. If they love your idea, they're gonna dump money into it. Do you have a hell of a story to tell? The WeWork's an exact example. If you're a great storyteller and you
Oh,
can just tell a good story and people believe into you, they're gonna dump insane money into you. And I just there's less logic and reason inside it. At least there was. I bet with the new economy and with things going on, money's a lot tighter now. But
yeah.
you know,
I think the WeWork story is the perfect example, right? Where he was able to get valuations on a fintech kind of, no, not a fintech, but a SaaS kind of startup where it was just real estate. That's a funny story. But yeah, I think
He
VCs
got
have
he
kind of,
got paid to leave, and he's doing it again, by the way. He's got
yeah.
another project he's raising money for, and people are investing in him.
I mean,
So,
he's a great guy. He's very smart. It's not easy to do that, but I think VCs are more. They're shifted more, and they want to see that you're able to be profitable. And once you've shown that you can be profitable and not burn cash, that's where they will invest in the growth. But what had happened throughout the years is they will invest in you regardless of where your ability to be profitable. And ultimately, what you want to become, no matter what business you're creating, no matter what you get into, you want to create cash flow, right? You want to have the
right.
ability to create cash on a monthly basis. So what happens with the VCs is they were investing in all these startups before they show their ability to create cash and be profitable. And now I think that they shifted to a model where, okay, first show me your ability to create cash and be cash flow positive, and then I will invest whatever capital I have to invest in order for you to grow and do 10 times, 20 times that cash flow.
It's funny how rationality comes back into play when money gets tighter. Yeah. Well, we're getting close to the top of the hour now. So tell us, everybody, kind of how do people reach out to Boopos and make that contact and show you something they want funded, or how do people reach out to you?
Yeah, absolutely. So just go to boopos.com, type on Google, you should find it. You can go to acquire.com also and search for deals that have a pre approved batch. And also feel free to reach out to me via LinkedIn. I'm happy to talk to anybody, even if you don't want to buy a business or just thinking about buying it. I love to talk to people just like kind of you, Ronald, where I enjoy having these conversations, learning from people. So I'm always eager to meeting new people in this space, or just reach out to me for a genuine conversation. I always enjoy that for real.
How do you want them to reach out to you? Are you active on LinkedIn, or what's your preferred social media platform?
Yeah, LinkedIn. I'm very active in LinkedIn, so that would be the best way.
I'll make sure those links are in the show notes. And thank you for being here today. We'll call that a show.
All right, thank you very much.
I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.